Welcome. If you run a business in Canada or advise someone who does, you've certainly come across the term dividend. But what you might not realize is that there isn't just one type. There are two very different kinds, and, well, designating the wrong one can lead to some quite significant penalties. Today, we're going to demystify the world of Canadian corporate dividends. We'll break down a system that, while it may seem complex on the surface, is actually built on a very simple, elegant idea: fairness.
So let's dive right in. The absolute key to understanding Canadian corporate dividends is to think of them as a tale of two different pools of income. You see, a corporation can't just pay out its profits however it likes. It has to meticulously track exactly what kind of tax that money has already been subjected to. And it's this tracking system that we're going to unravel together today.
All right, here's our roadmap. We're going to start with the foundational principle behind the entire system, something called tax integration. From there, we'll get into the specifics of eligible versus non-eligible dividends. Then we'll uncover the accounting pools that make it all work. That's GRIP and LRIP. And finally, we'll examine the very serious penalties for getting any of this wrong.
And this brings us to the central question we're really trying to answer today. Why is it that the tax system treats two dividend payments, which look identical, so differently once they land in a shareholder's bank account? The answer, as you'll see, is rooted in a concept of fairness that is fundamental to Canadian tax policy.
That core concept is called tax integration. Think of it as the North Star for this entire system. The objective here is actually quite straightforward: to create a level playing field no matter how a dollar of income is earned.
So here's the crucial point. The system is specifically designed to be neutral. Whether you earn, say, $100 as a sole proprietor, or you earn that same $100 through a corporation that you own, the total tax paid when you combine the corporate tax and the personal tax should end up being roughly the same. This principle is what prevents what we call double taxation, where the same dollar gets hit with the full tax rate twice.
Okay, so to achieve that integration, the system creates two tiers of dividends. This is the how behind the why. Based on the tax that the corporation has already paid on its income, the dividend it distributes is going to fall into one of two categories, and each one has its own distinct set of tax rules for the shareholder. Now, what's really fascinating here is the direct link. Eligible dividends, they come from income that was taxed at the full, high general corporate rate. Because the company paid more tax up front, the system gives the shareholder a break in the form of a better tax credit, which results in lower personal tax. Conversely, non-eligible dividends come from income that already got a tax break at the corporate level, most commonly the small business deduction. So to keep things integrated, the shareholder pays a higher rate of personal tax to make up that difference. It's a balancing act. And this table shows you the real-world impact. Just look at the bottom line. For the exact same $1,000 dividend payment, the shareholder who receives an eligible dividend pays about $27 less in federal tax. Now, this isn't magic, it's math. It happens through a bigger gross-up, which is the system's way of putting the pre-tax corporate income back onto the shareholder's return and a much larger dividend tax credit. This is how tax integration works in practice. So this brings us to the next logical question, right? If a corporation has different kinds of income, how on earth does it manage and track its ability to pay out these two different kinds of dividends? Well, the answer lies in two very critical, though notional, accounting pools. The first of these accounts is primarily for a specific type of company, Canadian-controlled private corporations, or CCPCs. It's called the General Rate Income Pool, but you'll almost always hear it referred to as GRIP. I want you to think of GRIP as the eligible dividend bucket. As a CCPC earns income that's been taxed at that high general corporate rate, it fills up this bucket. The balance in this conceptual bucket represents the maximum amount of eligible dividends that corporation can pay out without getting into trouble. The calculation for this is actually very specific. Each year, a CCPC adds approximately 72% of its full rate taxable income into its GRIP balance. Now, you might be asking, why 72%? It's not a random number. It's the government's carefully calculated approximation of the after-tax portion of that income. In other words, what's actually left over and available to be distributed to shareholders. Now for public corporations or other private corporations that don't meet the CCPC definition. The logic is completely flipped on its head. Instead of tracking their capacity to pay eligible dividends, they must track their obligation to pay non-eligible dividends first. And they do this through an account called the Low Rate Income Pool, or LRIP. So if GRIP is the eligible dividend bucket, then LRIP is the non-eligible dividend bucket. It tracks any income that received some kind of tax break. But the critical difference here is the word must. You see, unlike GRIP, which is a limit on what you can do, LRIP is a barrier. This bucket must be emptied out completely before the corporation is even allowed to pay a single dollar of eligible dividends. This is what's known as the LRIP ordering rule. And for these types of corporations, it is absolutely non-negotiable. If a company has even $1 in its LRIP account and it attempts to pay an eligible dividend, it has made a very serious and very costly error. Which brings us logically to our final section, the consequences. The government takes these dividend designation rules extremely seriously. And, as you'd expect, the financial penalties for mismanaging these pools are substantial. The technical term for this mistake is an excessive eligible dividend designation. For CCPC, this simply means paying out more in eligible dividends than it had in its GRIP balance at the end of the year. For non-CCPC, it's a bit different. It means paying any eligible dividend while still having a positive LRIP balance.
The penalty for making this kind of mistake is not a slap on the wrist. The corporation becomes subject to a special tax equal to a full 20% of that excessive designation amount.
This penalty is formally known as Part 3.1 tax. And trust me, seeing that particular line item on a notice of assessment from the CRA is a very clear and very expensive sign that the dividend pools were not managed correctly. And it's important to note, the system does have teeth. If the Canada Revenue Agency finds that transactions were structured specifically to manipulate these pools, say to artificially inflate GRIP or reduce LRIP, the anti-avoidance rules can kick in and the penalty can jump to 30% of the entire dividend amount, not just the excess portion. So let's quickly summarize what we've covered today. The entire system is built on that principle of tax integration, which is all about fairness. This is achieved through a two-tier dividend system. CCPCs use their GRIP account to track their capacity to pay eligible dividends. Other corporations, however, must clear out their low-taxed income from their LRIP account before they can pay any eligible dividends. And, most importantly, making a mistake here is costly, triggering a significant 20% penalty tax. We'll end with this question, which really gets to the heart of the matter for business owners and their professional advisors. The system we've just walked through is a delicate balancing act. Understanding these rules is not just an academic exercise, it's absolutely fundamental to sound corporate financial management in Canada with very real and very significant tax implications.